Hi there. Closing a solvent company involves important decisions. Let's compare Members Voluntary Liquidation and strike-off to help explain the differences.
Right, let's get straight into it. If you're a UK director of a small limited company and you're thinking about winding down your solvent business, you need to pay very close attention to this. Choosing the wrong exit strategy for your company isn't just a minor administrative hiccup. It could quite literally cost you tens of thousands of pounds in completely unnecessary taxes. So in today's explainer, we're breaking down the exact decision framework between an informal strike-off and a formal Members Voluntary Liquidation, or MVL. Let's dive in. Picture this, because it's an incredibly common scenario. You've worked hard for years, you've built up your company's reserves, and you finally decide to close down and pull out that remaining cash yourself using a simple, cheap strike-off form. You run the numbers, calculate your final distribution, and it comes out to exactly £25,001. You're probably thinking, brilliant, I'll pay a bit of capital gains tax and pocket the rest, right? Well, hold on a second. Missing a very specific statutory mark by just a single pound completely changes how HMR Revenue and Customs taxes your hard-earned profits. And this perfectly illustrates the danger: £25,001. If you extract this exact amount via a standard voluntary strike-off, every single penny of that distribution suddenly gets hit with the higher rate dividend tax instead of those lovely favorable capital gains rates. You don't just pay that higher tax on the £1 over the limit, no, you pay it on the entire £25,001 pot. It is a brutal tax trap, and honestly, it catches countless UK entrepreneurs totally off guard. But don't panic, because you're not navigating this alone. Throughout this step-by-step tutorial, you're going to be guided by the expertise of Atlas Tax Advisors, or ATA. They're a premier UK accounting firm entirely dedicated to helping individuals and business owners completely master their tax compliance. ATA are the experts who'll safely guide you through this complex tax maze today, making absolutely sure you retain the maximum possible profit from your company closure. Here's our roadmap for today. 1. The costly £1 mistake. 2. Strike-off versus MVL explained. 3. The crucial $25,000 threshold. 4. Navigating BADR in 2026. 5. The step-by-step decision framework. And 6. Summary, disclaimer, and CTA. Let's start with Section 1, the costly £1 mistake. We really need to hammer home the high stakes of extracting your company reserves blindly here. When you close a solvent company, the absolute most important factor determining your take-home cash is how HMRC categorizes your final payout. Is it income or is it capital? There is a huge misconception about this. Under Section 1030A of the Corporation Tax Act 2010, the threshold is not a progressive allowance, where only the excess is taxed heavily. It is an absolute cliff edge. If you distribute £24,999 through a strike-off, happy days, it's treated as capital. But hit $25,001, the whole amount is reclassified as dividend income. For a higher rate taxpayer, you're suddenly looking at a 35.75% tax rate on everything. Ouch. Moving on to Section 2, strike-off versus MVL explained. So how exactly do we avoid stepping into that trap? It all comes down to choosing the right legal pathway. On one side, we've got the voluntary strike-off. This is your administrative DIY process. You just make sure the company hasn't traded for 3 months, pay off your debts, and file a DSO1 form with Companies House. As of February 2026, that's just a £13 digital filing fee. It's cheap and it's fast. On the flip side, we have the Members Voluntary Liquidation, or MVL. Now, this is a formal statutory process under the Insolvency Act 1986. You actually have to hire a licensed insolvency practitioner to act as your liquidator. Yes, it costs a few £1,000s in fees, but it provides incredible peace of mind. A licensed professional ensures the whole thing is legally watertight and highly tax efficient, mainly because all your distributions, regardless of size, are safely treated as capital. Now, if you go down the MVL route, you enter a formal timeline. The absolutely crucial step here is the declaration of solvency. A majority of your directors actually have to swear a statutory oath that the company can pay all of its debts plus 8% statutory interest within 12 months of the liquidation starting. This is a very serious legal document. Getting it wrong carries severe penalties, including personal liability. But once it's sworn, the liquidator steps in, realizes your assets, secures tax clearance from HMRC, and safely distributes the funds to you. Section 3, the crucial $25,000 threshold. All right, here is the determining factor for about 99% of UK limited company directors. £25,000. This is the absolute statutory threshold. If your company's total distributions, and listen, this includes cash and, crucially, any physical assets you transfer to yourself, like company laptops, equipment, or vehicles, if that total is strictly under £25,000, that simple £13 strike-off works perfectly for you. You get favorable capital tax treatment without breaking a sweat. But if your total reserves creep over that £25,000 mark, an MVL essentially becomes mandatory if you want to avoid that punishing dividend tax rate on the whole pot. On to Section 4, Navigating BADR in 2026. Okay, let's say you've got £100,000 in reserves, so you wisely decide to take the MVL route. Why is getting that capital treatment so incredibly lucrative right now in the 2026-27 tax year? Well, we're talking about business asset disposal relief, commonly known as BADR. You might actually remember it by its old name, Entrepreneur's Relief. BADR is quite literally the ultimate tool to protect your retained profits. When you close down via an MVL, BADR treats your qualifying distributions as capital gains rather than income, and it applies a heavily discounted tax rate to those gains, up to a lifetime limit of £1 million. Following the recent autumn budget changes, the BADR rate for the 2026/27 tax year sits at 18%. Now, just take a second to really process that. Paying 18% on your capital gains is phenomenally better than the 35.75% higher rate dividend tax you'd suffer if you tried to pull a large sum through a standard strike-off. The difference in the actual cash you get to keep in your pocket is staggering. When the experts at ATAs sit down with clients, they always show them the maths on this. Let's look at the hard numbers together. Imagine you have £100,000 net distribution. If you use a strike-off, it's taxed as a dividend. A higher rate taxpayer would lose over £35,000 straight to HMRC, leaving them with roughly £64,000. But what if you use an MVL? Even after you pay an average £3,000 liquidator fee, that remaining £97,000 is taxed at the 18% BADR rate. You'd pay around $17,000 in tax. By choosing the MVL, you've legally saved yourself thousands and thousands of pounds. Mathematically, the break-even point where paying an MVL fee actually pays for itself is when your reserves hit around $12,000. But practically speaking, that $25,000 statutory limit is your real trigger point. Section 5. The step-by-step decision framework. So, how do you actually apply all of this to your own specific situation? Here is your definitive 4-step framework. Step 1. Assess your solvency. Can the company truly pay all its debts within 12 months? Because if it can't, you can't use an MVL or a strike-off. You'd need an insolvent liquidation. Step 2. Check the £25,000 threshold. Are your total reserves above or below this line? Step 3. Evaluate your BADR eligibility. And finally, Step 4. Execute the closure while carefully avoiding the tar trap. Let's look a bit closer at Steps 3 and 4, as they are massive tripwires. To actually claim that sweet 18% BADR rate, you have to meet some really strict conditions for a continuous 2-year period ending on the exact date of liquidation. You must hold at least 5% of the ordinary share capital and voting rights. Your company must be a genuine trading company, not just a passive investment vehicle holding properties or shares. And crucially, you must be an officer or employee of the company. Look, we've seen directors enthusiastically resign on day 1 of the wind down, instantly ruining their eligibility. Whatever you do, do not do that. Finally, you absolutely must navigate the Targeted Anti-Avoidance Rule, or TAR. HMRC created this specifically to stop what's called phoenixing, which is when you close a company just to extract cash at those lovely lower capital gains rates, only to turn around and start up the exact same business the very next day. For example, if you're an IT contractor, you can't close your company to get the 18% rate and then start a brand new IT contracting company a month later. If you held a 5% interest, your company was closely held, you start a similar trade within 2 years, and HMRC assumes your motive was tax avoidance, they will retroactively reclassify your capital gains as dividend income and hand you a massive, nasty tax bill. You absolutely must have documented commercial reasons for closing. And before we wrap up, here is a really powerful professional tip from the experts at Atlas Tax Advisors. Before you close your doors for good, make sure you utilize terminal loss relief. If your company incurred trading loss in its final 12 months of winding down, you can actually carry that loss back and offset it against the profits of your previous 3 years. This could potentially generate a highly lucrative corporation tax refund for you right before your company is officially dissolved. It's a fantastic strategy. Finally, Section 6, Summary, Disclaimer, and CTA. First off, a quick but very important disclaimer.
This explainer provides educational information on UK tax frameworks for the 2026/27 tax year and does not constitute formal financial, tax, or legal advice. While the rules we've discussed apply broadly, every single company is completely unique. Individual tax situations, especially when you get into the weeds of BADR eligibility and the TAR rules, really do require personalized professional assessment.
And that is exactly why you need an expert in your corner. I highly encourage you to reach out directly to Atlas Tax Advisors using the details on screen right now. Give them a call at 07404 427275, drop them an email at info@atlastax.co.uk, or just visit their website at www.atlastax.co.uk. The team at ATA will assess your specific reserves and ensure your hard-earned wealth is completely protected during your company closure. Also, please do subscribe to the ATA YouTube channel for more essential compliance explainers just like this one. I'll leave you with this final provocative thought. If HMRC audited your company closure tomorrow morning, are you 100% confident your capital extraction would survive their scrutiny? Reach out to ATA today and make absolutely sure the answer is yes.